Good morning, and welcome to Technical Analysis 101. We're about to build together over the next 6 days a complete, testable toolkit for reading price charts the way a professional analyst does. Today is day 1, and it carries the heaviest structural weight of the entire course, because everything you learn in days 2 through 6 sits on top of what we cover today. We're going to do this today in 2 parts. In the first half, we lay the foundations, what technical analysis actually is, the 4 families every indicator belongs to, and a deep, hands-on treatment of the 2 moving averages that underpin almost everything else in this field, the simple moving average and the exponential moving average. In the second half, we go further than a typical introductory module. We'll look at Stan Weinstein's stage analysis framework, then bridge into advanced trend tools, slope and velocity metrics, and structural change point detection, so that by the end of today, you're not just plotting a moving average, you understand what it's actually telling you about the stage a stock's life cycle is in. Let's begin. Before we go any further, a short but important note. Dreamlit Equity Research and its instructors are not SEC-registered investment advisors, and nothing in this course constitutes investment, financial, or legal advice. Every concept you learn today is being taught for educational and skill-building purposes only. Dreamlit Equity Research bears no responsibility for investment decisions, trading losses, or damages arising from how you choose to apply these concepts in live markets. That application and that risk is entirely yours. If and when you do decide to trade or invest using any of these tools, please consult a SEC-registered investment advisor or conduct your own independent due diligence first. My job today is simply to build your knowledge. What you do with that knowledge and how carefully you verify it is squarely your responsibility. With that said, let's get into the material. Here is the map for where we're headed across all 6 days, because context matters. You learn a tool faster when you know where it fits in the bigger picture. Day 1, where we are right now, covers foundations and moving averages, the simple moving average, the exponential moving average, and basic trend concepts. Day 2 moves into momentum oscillators 1, the relative strength index, and MACD. Day 3 is volatility and trend strength, covering Bollinger Bands, ADX, and the commodity channel index. Day 4 continues with momentum oscillators 2, the sham momentum oscillator, rate of change, Williams percent, R, the stochastic momentum index, and the detrended price oscillator. Day 5 is volume and adaptive trend tools, Chaikin money flow, elastic volume-weighted moving average, zero lag EMA, and parabolic SAR. And day 6 closes the course with a strategy and fundamental crossover, the Piotrowski F-score, combining signals across everything you've learned, and a capstone project. Notice the shape of that journey. We start with the slowest, most foundational tools and build steadily toward faster, more specialized ones. You are here at the very first step, and it's the step everything else depends on. So what exactly are we covering today? 4 blocks. First, we'll answer the question, what is technical analysis? Actually, its core assumptions, the basics of Dow theory, and precisely how it differs from fundamental research, because a lot of new students conflate the two. Second, we'll map out the 4 families of indicators: trend, momentum, volatility, and volume, so that every tool you ever learn in this course is an obvious home in your mental model. Third, and this is where we'll spend the bulk of our time, we go deep on the simple and exponential moving averages, formula, a fully hand-worked numerical example, chart interpretation, real use cases, and honest limitations for each. And fourth, we bring it all together in a strategy spotlight on the golden cross and the death cross, turning 2 moving averages into 1 rule-based, actionable trading signal. By the end of this agenda, you'll have the vocabulary and the tools to start reading a price chart with real intention. Let's start with a proper definition. Technical analysis is the study of historical price and volume data to forecast the probable future direction of a stock, an index, or any tradable asset, and it rests on the idea that all known information is already reflected in price. This framework traces back to Dow theory, and it stands on 3 pillars. 1. Price discounts everything. All available information, economic, political, psychological, is already baked into the current market price, so you don't need to independently know every catalyst. The price has already absorbed it. 2. Prices move in trends. Markets move in identifiable primary, secondary, and minor trends rather than randomly, and we assume a trend remains in force until proven otherwise. 3. History tends to repeat itself. Market psychology is repetitive. The same patterns recur again and again because human behavior around fear and greed doesn't really change from one market cycle to the next. Now, how does this differ from fundamental analysis? Fundamental analysis asks, what should I buy? Using financial statements, valuation, and business quality. Technical analysis asks a different question entirely. When should I buy or sell? Using price, trend, and momentum patterns. Keep that distinction in your head throughout this entire course. Fundamentals tell you what, technicals tell you when. Every single indicator you will ever learn, in this course or anywhere else, belongs to one of 4 families, and knowing the family tells you what question that tool is actually trying to answer. Trend indicators ask, where's price headed? Tools like the simple and exponential moving averages, the zero-lag EMA, ADX, and parabolic SAR. Momentum indicators ask, how fast is price moving? RSI, MACD, the sham momentum oscillator, rate of change, Williams %R, and the stochastic momentum index. Volatility indicators ask, how wide is the price range? Bollinger Bands, the commodity channel index, and the detrended price oscillator. And volume indicators ask, how strong is participation behind the move? Chaikin money flow, and the elastic volume-weighted moving average. Today, our focus is squarely on the trend family, because trend-following tools are the most intuitive entry point into technical analysis. And, as you'll see later today, they're also the foundation that stage analysis itself is built on. Hold on to this 4-family map. We'll keep returning to it every single day of this course. That's our conceptual foundation laid. Now we move into part 1 of day 1. Moving averages, the building blocks of trend-following technical analysis. We're going to cover the simple moving average and the exponential moving average in real depth, and then show you how to combine them into one genuinely actionable trading signal. This is arguably the single most important 30 minutes of the entire course, because moving averages are the input to a huge share of everything that follows. MACD, ADX, zero-lag EMA, and the stage analysis framework we'll cover later today all sit directly on top of the concepts you're about to learn. Let's build them from the ground up. Our first tool is the simple moving average, or SMA, a trend family, lagging indicator. What does it do? The SMA smooths out day-to-day price noise by averaging the closing price over a fixed number of recent periods, giving every single period equal weight. It reveals the underlying trend direction that raw, jagged price action tends to hide from the naked eye. The formula: SMA over N periods equals the sum of the closing prices, P1, P2, all the way through Pn, divided by N, where P sub I is the closing price of period I, and N is the number of periods you choose, commonly 20, 50, or 200 days. Now, why does equal weighting matter so much? Because each of the N prices contributes identically to the average. A single sharp spike from several days ago carries exactly the same influence as today's closing price. That's precisely why the SMA is smooth, but also slow to turn. It has a kind of institutional memory that doesn't fade until that old price finally rolls out of the window. 3 quick facts to remember. Its type is lagging and trend following. Its signal speed is slow, and it performs best in genuinely trending markets. Next, we'll work through the full arithmetic by hand. Let's make this concrete. On screen, you'll see 1 year of daily closing prices, and we compute a 10-day, simple moving average against them. The table walks you through the rolling calculation. For any given day, you take the 10 most recent closes, sum them, and divide by 10. Then, as each new day arrives, the window slides forward 1 step. The oldest price in the window drops off, the newest price is added, and you're always averaging exactly 10 closes. Look at how the resulting SMA line behaves on the chart. It climbs steadily from around 14 up to around 16 over the course of a year. Notice what that line is doing for you. The raw daily closes are jagged, with plenty of single-day wiggles, But the 10-day SMA filters all of that out and gives you one clean, confirmable statement. This stock is in an uptrend. That is the entire value proposition of a moving average in one chart. It trades a little bit of timing precision for a much clearer read on the direction that actually matters. Now let's talk about how to actually read and use this tool. 3 interpretation rules. When price is above the SMA, that's an uptrend, a bullish bias, and the SMA itself often behaves as a dynamic support level. When price is below the SMA, that's a downtrend, a bearish bias, and the SMA tends to act as dynamic resistance instead. And when the SMA's own slope is rising or falling, that confirms the strength and direction of the underlying trend. A rising slope means the trend is gaining conviction. In terms of real-world use cases, the 200-day SMA is the classic long-term trend filter, separating bull regimes from bear regimes at a glance. The SMA provides dynamic support and resistance for entries on pullbacks, and it's the essential building block for crossover strategies, including the golden cross, which we'll build later today. But, and this is important, 3 real limitations to respect. Lag. Because it averages the past, the SMA always trails the current price, so its signals arrive late. Whipsaws. In sideways, choppy markets, price crosses the SMA repeatedly, throwing off false signals. And equal weighting itself. Old and recent prices count exactly the same, even though recent prices are usually more informative about what's happening right now. Keep these limitations in mind. They're precisely the weaknesses the exponential moving average is designed to address. That brings us to our second tool, the exponential moving average, or EMA, also lagging, but meaningfully faster. What does it do? The EMA is still a moving average of price, but instead of weighting every period equally, it applies exponentially greater weight to more recent closes. That makes it hug price more closely and react faster to new information than an SMA of the same length. The formula: today's EMA equals today's closing price multiplied by a smoothing constant K, plus yesterday's EMA multiplied by 1 minus K. That constant K equals 2 divided by the quantity N plus 1. Why does this weighting matter so much in practice? A larger K, which comes from a shorter N, means today's price dominates the average, so a 9-day EMA reacts noticeably faster than a 50-day EMA. Every past price still has some residual influence on an EMA. It simply decays exponentially rather than dropping off a hard window edge the way it does in an SMA. One practical note: in real implementations, the very first EMA value is typically seeded using the SMA of the first N periods, and the exponential formula only takes over from the next period onward. You'll see exactly how that works in the worked example ahead. Quick facts: common periods are 9, 12, 20, 26, and 50. It reacts faster than the SMA and turns earlier at reversals. And it's the core building block of MACD, which you'll meet on day 2. Now let's run the same year price data through a 10-day EMA and put it side by side, mentally, with the SMA you just calculated. Watch what's different. Because the EMA seeds from that initial SMA value and then applies the exponential weighting formula period by period, it tracks price more tightly from the very start. Where the SMA smoothed everything into one steady, almost lazy climb, the EMA visibly hugs the day-to-day, closes more closely. It dips a little harder on down days and pushes a little higher on up days because recent price action is doing more of the work in each calculation. This is the weighting difference from the formula slide made visible on a chart. Same underlying data, same 10-period length, but a meaningfully different personality. That personality difference, smoother but slower versus choppier but faster, is exactly what you'll be choosing between every time you pick a moving average for a strategy. How do we read and apply the EMA? When price is above the EMA, that's short-term bullish momentum, with the EMA acting as a tighter, faster support level than the SMA would give you. When price is below the EMA, that's short-term bearish momentum, with the EMA acting as tighter, faster resistance. And when a fast EMA crosses a slow EMA, that's an early warning of a possible shift in trend direction. This is the exact mechanism MACD is built on. Real-world use cases, short-term swing trading entries, and trailing stop-loss levels. It's a core input to momentum tools, since MACD is literally built from two EMAs, as you'll see on day 2, and it's useful for spotting reversals early in fast-moving or news-driven stocks. But respect its limitations too. More false signals. Its sensitivity to recent price makes it snap to short-lived noise more readily than the SMA does. Still lagging. It reacts faster than the SMA, but it remains a lagging indicator built entirely on past prices. It is never predictive. In parameter sensitivity, your choice of N changes its behavior substantially. A 9-period EMA and a 50-period EMA can genuinely disagree with each other on the exact same chart. Choose your period deliberately, based on the time horizon you're actually trading. Let's take a short but valuable detour into implementation, because you should never take a formula on faith. You should see it computed. Here's how you'd calculate both averages in R, using the QuantMod package. Step 1. We load the QuantMod library, which bundles the SMA and EMA functions along with plotting tools. Step 2. We fetch 1 year of daily price data for NVIDIA, from exactly 1 year before today's date up to today. Step 3. We compute a 10-period simple moving average of the closing price. One line of code, calling the SMA function on the closing prices with N equal to 10. Step 4. We compute a 10-period exponential moving average the same way, just calling EMA instead of SMA. And step 5. We plot the raw closing price, then overlay the SMA in blue and the EMA in red on top of it. That's genuinely the entire implementation. 5 lines that turn everything we've discussed conceptually into a real, reproducible chart. I'd encourage you to run this yourself on a ticker you actually follow. Watching the blue and red lines diverge and converge in real time will cement today's lesson far better than any slide can. Let's look under the hood at what same window, different weights actually means, because this chart makes it completely concrete. The white line is raw daily price. The yellow dots are the 10-day SMA. The pink dots are the 10-day EMA, and notice how closely they track each other on top of price. That's expected, since both are built from the exact same 10-day window. The real story is in the 2 panels below. The middle panel shows the SMA's weights for the highlighted window on the right. 10 bars, every single one sitting at exactly 0.1, dead flat. That's equal weighting in its purest form. Each of the 10 days contributes precisely 1/10 of the average, whether it's the oldest day in the window or today. The bottom panel shows the EMA's weights for that same stretch, and the shape is completely different. The bars climb steadily, from roughly 0.03 up to about 0.15, with the most recent day carrying by far the largest weight. This is the exponential decay we talked about in the formula slide, made visible as an actual bar chart instead of an abstraction. And here's the phrase in the title worth sitting with, repeating the same process for every day. Every single day, this same weight distribution gets recalculated and reapplied to a new 10-day window. For the SMA, 10 flat bars of 1/10 each. For the EMA, that same rising staircase, always leaning hardest on whatever the newest price happens to be. That's the entire mechanical difference between these two averages, distilled into one picture. When you're deciding which moving average to use in your own analysis, this is the picture you should have in your head. EMA for speed, SMA for smoothness. Let's now put the SMA and the EMA side by side directly, attribute by attribute, because this comparison table is one you'll want to internalize. On weighting, the SMA is equal across all N periods, while the EMA is exponentially higher for recent periods. On responsiveness, the SMA is slower to react, the EMA is faster. On smoothness, the SMA is smoother with fewer false flips, while the EMA is choppier and more sensitive to noise. On best use case, the SMA suits long-term trend confirmation, the EMA suits short-term entries and timing. And on typical periods, the SMA is commonly used at 50 and 200 days, while the EMA is commonly used at 9, 12, and 26 days. The chart on this slide overlays close price, the 5-day SMA, and the 5-day EMA together, and you can see the EMA consistently sitting a touch closer to the raw price line. So here's the rule of thumb I want you to take away. Use the SMA to confirm that the big picture trend is genuinely intact, and use the EMA to time your actual entry or exit within that trend. Most experienced traders don't choose one over the other. They plot both together and let each one do the job it's best suited for. Now we turn two moving averages into one genuinely actionable, rule-based signal, typically the 50-day and the 200-day SMA. The golden cross is a bullish signal. The short-term 50-day average crosses above the long-term 200-day average, suggesting that recent momentum is now strong enough to reverse the longer trend upward. It's typically read as the start of a new bull phase, and it's used by institutional investors as a long-term buy trigger. The death cross is its mirror image, a bearish signal. The 50-day average crosses below the 200-day average, suggesting recent weakness is strong enough to reverse the longer trend downward. It's typically read as the start of a new bear phase, and it's often used as a signal to reduce exposure or tighten stop losses. But here's the trader's caution I want you to genuinely absorb. Not just here, because both of these lines are lagging indicators. The crossover confirms a trend change well after that change actually begins, and it can whipsaw badly in sideways markets. Never interpret a golden or death cross in isolation. Confirm it with volume, with momentum indicators, which we cover from day 2 onward, or with price structure. Let's ground that in an actual chart. What you're looking at here is a real historical example of a 50-day and 200-day moving average crossover playing out on a live stock. Trace the two lines with your eye. For a long stretch, the shorter average sits below the longer one. Price is under pressure, and then momentum builds until the 50-day average physically pushes up through the 200-day average. That crossing point is the golden cross itself, marked right where the trend genuinely began to turn. Notice, just as we discussed on the previous slide, how much price movement had already happened by the time that cross was confirmed. That gap between the real turn and the confirmed signal is the lag we keep coming back to. It's the entire reason later in today's lecture we're going to introduce change point detection as a faster alternative. Here's the same concept in another ticker. Death cross is SMA 50, SMA 200, and golden cross is SMA 50, SMA 200. Let's step back and look at moving averages through a completely different lens. Stan Weinstein's 4-stage analysis. Stage analysis categorizes a stock's entire life cycle into 4 distinct phases, based on where price sits relative to its 30-week, or equivalently, 150-day, simple moving average, and the slope of that average. Stage 1 is basing, or accumulation. Price oscillates sideways in a neutral range around a flattening 30-week moving average, while smart money quietly builds positions without moving the price much. Stage 2 is the advancing phase. This is confirmed when price breaks above resistance, above a now rising 30-week moving average on heavy volume. A sustained uptrend of higher highs follows. Stage 3 is distribution, or the top. Price moves wildly within a top range as institutional profit-taking absorbs incoming buying interest, and the 30-week moving average flattens out again, mirroring the basing phase in reverse. And stage 4 is the declining phase, a confirmed breakdown below support, with a declining 30-week moving average, brings severe downside pressure as panic selling takes over. Notice something important here. Every single one of these 4 stages is defined using tools you already know: price location relative to a moving average, and that moving average's own slope. This is the payoff of everything we built in the first half of today's lecture. Let's turn this into a precise identification checklist you can actually apply to a chart, stage by stage, across 4 criteria. Price versus the 30-week moving average, the moving average's slope, volume behavior, and the key technical trigger. Stage 1, basing. Price oscillates above and below the moving average. The slope is flat and horizontal. Volume contracts significantly, and the key trigger is an initial stabilization after a steep prior decline. Stage 2, advancing. Price consistently trades above the moving average. The slope is steeply sloping upward. Volume expands 2 to 3 times the average on breakouts, and the trigger is a breakout above resistance on heavy volume. Stage 3, top area. Price crosses back and forth through the moving average erratically. The slope flattens after a long rally. Volume spikes on down days in an erratic pattern, and the trigger is a failure to hold new highs alongside rising volatility. Stage 4, declining. Price consistently trades below the moving average. The slope is steeply sloping downward. Volume expands on breakdowns while rally attempts fail on light volume. And the trigger is a breakdown below the basis support line. And here is the single most important operating rule from this entire framework. So listen carefully. The 30-week simple moving average acts as the supreme filter. Never buy a stock trading below a declining 30-week SMA. That's stage 4. No matter how cheap the fundamental valuation appears to be. Valuation tells you what might eventually be true. The 30-week moving average tells you what the market is doing right now. And in stage analysis, price action wins that argument every time. Now let's see this classification applied to a real, continuous price history, because the story here is messier and more honest than a single clean cycle. Trace the chart left to right. For most of 2024 into 2025, this stock lives in stage 2, advancing, with the moving average sloping steadily upward beneath a strong, if volatile, uptrend. But notice it doesn't advance in one straight line. Twice around early 2025 and again near the end of that year. The rally loses its shape, price whipsaws hard, and a shading flips to stage 3, topping, before a fresh leg higher pulls it back into stage 2 once more. That back and forth is realistic and important. Stocks often test a top 2 or 3 times before actually rolling over. Then, heading into 2026, watch the decisive shift. A brief stage 1 basing pocket, and from there the moving average finally rolls into a sustained downward slope and price drops firmly below it, triggering stage 4, declining, for an extended stretch through the first half of 2026. The title tells you exactly how that call gets made mechanically. The 150-day moving average fell 0.58% over the last 10 trading days, past a negative 0.5% threshold, with price sitting below the average, and that combination is what flips the classification to declining. Notice the chart closes with price attempting a rally back toward the moving average, and the shading briefly returns to stage 1 basing at the very end. A reminder that this framework is diagnostic, not predictive. It tells you what stage the evidence currently supports, and it's willing to change its mind the moment the evidence does too. We've now covered the complete foundational arc. The SMA, the EMA crossover strategy, and the stage analysis framework that gives all of it real structural meaning. In this second part of today's lecture, we go one level deeper into territory most introductory courses skip entirely. We'll look at advanced moving average variants that were purpose-built to fix specific weaknesses in the plain SMA and EMA. We'll quantify trend strength and price stretch using slope and disparity metrics, turning what you've been reading visually into objective numbers. And we'll close with structural change point detection, a statistical approach to spotting the exact moment a regime shifts, which gives us a genuinely faster, more rigorous way to catch the same stage 1 to stage 2 transition we just spent the last several slides learning to read by eye. Think of this section as the bridge from basic crossovers into a quantitative version of stage analysis. Let's meet 3 purpose-built moving average variants, each one designed to fix a specific weakness we already identified in the SMA and the EMA. First, the whole moving average, or HMA. It cuts lag substantially by taking a weighted moving average of the difference between a half-length and a full-length weighted moving average, and then re-smoothing the result over a window equal to the square root of n. In words, the formula is HMA equals the weighted moving average over the square root of n periods of 2 times the half-length weighted moving average minus the full-length weighted moving average. Second, the volume-weighted moving average, or VWMA. It weights each price by that period's traded volume. So heavy volume moves skew the average far more strongly than quiet, low volume drift. The formula is the sum of price times volume, divided by the sum of volume. Third, Kaufman's adaptive moving average, or comma. This one adjusts its own smoothing constant using something called an efficiency ratio, speeding up during clean, efficient trends and slowing down during noisy, range-bound chop. One honest caveat before we move on. All 3 of these remain lagging by construction. They react to price that has already happened, They're just faster or more selective about what they react to than a plain SMA. Now let's turn two things you've been judging visually all lecture. Is the line rising, and does price look stretched into objective, calculable numbers? First, the first derivative, or slope. The rate of change of a 50-day or 150-day SMA quantifies trend strength objectively, instead of you eyeballing whether the line looks like it's rising. The formula is simply slope equals the change in the moving average divided by the change in time. Read it this way. A rising, expanding slope means the trend is strengthening, with momentum building underneath price. A slope flattening toward zero means the trend is stalling. And this is often the earliest visual cue of a stage transition, well before price itself breaks any level. And a slope turning negative means the prior uptrend has structurally broken down. Second, the distance or the disparity index. This quantifies how far price has stretched away from its moving average, flagging zones where a mean reversion move becomes likely. The formula, disparity equals price minus the moving average, divided by the moving average, multiplied by 100, expressed as a percentage. A disparity reading near 0% means price is hugging the average, no stretch, an orderly trend. A large positive reading means price is overextended above the moving average, raising pullback risk. And a large negative reading means price is overextended below the moving average, raising bounce risk. Together, slope and disparity give you a genuinely quantitative complement to the purely visual reading you've been building all day. Here's what that looks like on an actual price chart. Notice the moving average's slope changing shape across different segments of the chart, steepening as the trend gathers strength, flattening as it stalls, and eventually rolling over. Now look at how far price occasionally stretches away from that moving average during the strongest legs of the move. Those are exactly the disparity extremes we just defined, the zones where short-term mean reversion pullback becomes statistically more likely, even while the broader trend, as told by the slope, remains intact. This is the practical value of turning a visual impression into two separate numbers. You can be confident in the trend, told to you by the slope, while still respecting near-term stretch risk, told to you by the disparity index. Two different questions, two different answers from the same moving average. Now for the most statistically rigorous tool in today's lecture, structural change point detection, a family of tests that flag the moment price behavior itself shifts, rather than waiting for a lagging average to physically catch up. Two methods worth knowing. First, CUSUM, or cumulative sum. It tracks the running cumulative sum of deviations between each return and its historical mean. A sharp, sustained drift away from zero signals that the underlying mean has structurally shifted, not just ordinary noise. Applied to price or returns, CUSUM is commonly used to flag the stage 1 to stage 2, basing to advancing, transition earlier than a purely visual chart reading would catch it. Second, the rolling t-test or mean shift test. It compares the mean return of two adjacent rolling windows, say, the last 20 trading days against the 20 days before that. A statistically significant difference between those two windows marks a candidate regime change point. It's simple to compute and easy to rerun on every new bar, which makes it a practical complement to CUSUM. CUSUM flags the shift, the rolling t-test helps confirm it. And here's why this genuinely bridges into everything we covered on stage analysis. That framework defines a stock's life cycle as stage 1, basing, moving to stage 2, advancing to stage 3, topping to stage 4, declining. Change point detection gives you a statistical trigger for exactly when the market has left one stage and entered the next. It is the quantitative counterpart to reading the chart by eye that we practiced earlier today. Here's the direct, honest comparison on one real chart. NVIDIA, with price in white, the 50-day and 200-day SMAs as the yellow and green dashed lines, and every change point flag marked as a thin cyan dotted line. The first thing to notice is that these cyan flags aren't rare. They fire repeatedly across the whole series. A cluster in late 2023, another cluster through the choppy consolidation in mid-2024, one in early 2025, and another late in 2026. That's the honest trade-off with change point detection. It's sensitive. It doesn't just catch the one big regime shift you care about. It also fires on smaller, shorter-lived shifts in the return series that don't necessarily turn into a lasting new trend. Now look at the two gray dashed lines in the middle of the chart. Those mark the actual 50-day, 200-day crossover events, right around the pullback from roughly 140 down to the 100 level. Notice the cyan flags cluster tightly around and just ahead of each gray line. Change point detection is picking up that shift in the return series days before the moving averages physically finish crossing. The QSM panel below tells the same story in more detail. It's constantly oscillating between green and red on ordinary days, but watch it swing hard negative right in that same 140 to 100 pullback window. A sharp, sustained move away from zero, which is exactly the kind of signal QSM is built to catch. So the real lesson here isn't that change point detection is simply better. It's earlier at the moments that matter, but it also asks you to filter out more noise along the way. Speed and sensitivity come as a package deal. Let's quantify that timing gap directly, and then connect it to one more confirming signal: volatility. First, moving average crossover lag reduction as a direct comparison. A 50-day, 200-day crossover signal waits for two full-length averages to physically cross before it fires, and its typical lag is measured in weeks after the true turn. A change point signal, using QSM or a rolling t-test, waits instead for a statistically significant shift in the return series itself, and its typical lag is measured in days after the true turn, not weeks. That is a materially faster read on the same underlying event. Second, volatility regime transitions. Tracking rolling standard deviation alongside moving average slope confirms a stage 1 to stage 2 transition. Volatility expands, and the slope turns positive at roughly the same time, giving you two independent confirmations instead of one. In stage 1, basing, volatility is low and compressing, and the moving average slope sits approximately flat. At the transition, right around the change point, volatility begins expanding, and the slope turns positive. And in stage 2, advancing, volatility runs high and trending, with the slope rising and sustained. When you see compressing volatility suddenly start expanding at the exact same moment the slope turns positive, that convergence is about as strong a confirmation as classical technical analysis can offer that a genuine regime shift, not just noise, is underway. Let's bring everything from this second half of the lecture together on one final chart. Here you can see, layer on top of each other, the price series, the moving average with its changing slope, the volatility expansion right around the transition point, and the change point marker sitting close to where all of that activity begins. This is the complete, layered picture I want you to carry out of today's lecture. A single moving average slope tells you direction, a disparity reading tells you stretch, a volatility reading tells you regime, and a change point test tells you timing. Four different lenses, all pointed at the exact same underlying question, which is simply, has this stock's behavior genuinely changed? When several of these lenses agree at the same point on the chart, that is about as much confirmation as a technical analyst can reasonably ask for. Before we close out today's session, let's test what's actually landed. Take a moment, get out your notes, and work through these 5 questions. We'll review them together at the very start of day 2. Question 1. A stock's price is trading above its rising 50-day SMA. What does this typically indicate? Question 2. Why does a 9-day EMA respond to a price shock faster than a 50-day EMA? Question 3. What is the key difference between how the SMA and the EMA weight historical prices? Question 4. A trader sees the 50-day SMA cross below the 200-day SMA. Name this pattern and state its typical interpretation. And question 5. Why can a QSM test or a rolling t-test flag a stage 1 to stage 2 transition earlier than a standard 50-day, 200-day crossover can? If you can answer all 5 of these confidently, and in your own words, you have genuinely absorbed today's lecture, not just watched it. Let's consolidate everything into 6 takeaways you should be able to recite without looking at your notes. 1. Technical analysis assumes price discounts everything, that prices move in trends, and that history tends to repeat. It answers the question when, not the question what. 2. Indicators fall into 4 families: trend, momentum, volatility, and volume. and both the SMA and the EMA are trend family tools. 3. The SMA is an equal weighted average of N closes, following the formula SMA sub N equals the sum of P1 through Pn, divided by N, smooth but slow. 4. The EMA is an exponentially weighted average that reacts to recent price faster, following the formula EMA sub T equals price sub T times K, plus EMA sub T minus 1 times 1 minus K, where K equals 2 divided by N plus 1. 5. The SMA suits long-term trend confirmation at 50 or 200 days, while the EMA suits faster, short-term timing at 9, 12, or 26 days. And 6. A golden cross, the 50-day average crossing above the 200-day average, signals a possible new uptrend, while a death cross, the 50-day average crossing below the 200-day average, signals a possible new downtrend, and you should always confirm either signal with other tools before acting on it. Beyond these 6, remember the 2 bridges we built in the second half. Stage analysis translates moving average behavior into a full 4-phase market life cycle, and change point detection gives that same life cycle a faster, statistically rigorous trigger. Looking ahead today to Momentum Oscillators 1, where we cover the Relative Strength Index and MACD. RSI is a 0 to 100 bounded oscillator that measures the speed and change of price moves to flag overbought and oversold conditions. MACD is built from 2 EMAs, 12-period and 26-period, plus a signal line, combining trend following and momentum into a single indicator. And here's why day 2 follows so naturally from today. MACD literally uses the exact EMA formula you learned this lecture. You're going to watch, in real time, exactly how today's building blocks connect directly into tomorrow's tool. As a core structure reminder, days 3 through 6 then cover volatility and trend strength, momentum oscillators 2, volume and adaptive trend tools, and finally a strategy and fundamental crossover capstone, steadily building toward the complete indicator set in this 101 series. Come back tomorrow ready to build on today's foundation. That brings us to the end of day 1. We covered a genuine amount of ground today. What technical analysis is and isn't, the 4 families every indicator belongs to, a complete handwork treatment of the SMA and the EMA, the golden and death cross strategy, Stan Weinstein stage analysis framework, and a real introduction to advanced trend tools and structural change point detection. If there's one thread running through all of it, it's this. Every tool we covered today is trying to answer the same basic question. Where is this trend really, and how do we know when it's about to change? Review your knowledge check answers. Revisit the recap slide if anything felt shaky, and I will see you in day 2 for momentum oscillators, RSI, and MACD. Thank you for your attention today. Dreamlit Equity Research. Join us in next day's lesson.